The mistake people make quite often with IAS2 is that they try to apply net realizable value test to raw materials. We had a quiz. We had a company that produced safes. So this means that steel for that very company was not a finished good, but rather raw material. And as such, we don't care whatsoever what is the price of steel, whether it is increasing or decreasing. We care what the price of safes is. So if we take the current safe price and we are going to deduct the conversion costs, so labor cost, electricity, and so on, and we would arrive at the cost of steel, then that is something that we are going to compare against the carrying amount. And we are going to make this net realizable value test at each and every reporting date. That is different compared to whatever we have with our IAS 36 impairment of assets standard, because there we make an impairment test only when there is a trigger, when there is a sign of impairment. But for inventories, IAS2 is more important, so we are going to make annual retesting each and every reporting period, but we look at net realizable value of finished goods, not raw materials. And even if the question was about finished goods, whatever we have as raw materials is not a monetary asset. So you do not restate it to a different value. You don't recalculate the exchange rates. So if it was the finished good, then we would compare the price of the original recognition, so the carrying amount, the cost, and we would compare the net realizable value, which was calculated using the exchange rate at that very closing date. And that is how it works.